Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blikre, your host. The People's Voice is on assignment, and today we have Yahoo Finance senior reporter Alexandra Canal next to me. First, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming Nick Collis, co-founder of DataTrek Research. Hello, guys. I am excited because I followed Nick for years. This is the first time we've met on camera. And today we're going to be talking about institutional investors as opposed to retail, tapping our guest's experience in the industry, including a stint with Mets owner Steve Cohen at SAC Capital back in the day. Our phrase of the day is smart money. It beats dumb money, but is there such a thing? Do institutional traders really have the inside edge? And this episode is brought to you by the number 42%. That is the share of zombie companies in the small cap Russell 2000 index. What is the magic threshold that triggers the zombie small cap apocalypse? So Nick, before we really dig in, what do you think of the market action so far this year? We are taping this, I should know for the viewers, on Fed Day, and there's been a lot happening recently.
There really has. I mean, just the last week, we've had everything from Treasury rates finally starting to break down because we were worried about 5% 10-year yields, and now that's gotten a little better. We're back down towards 4.6, 4.7, so that's a positive. Then we had this staggering news over the weekend about Chinese artificial intelligence that rocked the market on Monday. So it's really been like at least a month's worth of news in just the last couple of days.
Well, I want to get to our word of the day here, our phrase of the day, and we were talking about this just before the show. It is smart money, and I'll give you the definition. Is it formal? Well, we're just going to get to it. Smart money refers to institutional investors, hedge funds, pensions, and pros who are thought to have superior research, execution, and market access, often moving ahead of retail traders. So there's a lot of probably misinformation about what constitutes smart money versus dumb money. There was even a movie made about the latter. What do you think about these terms?
I don't like them very much. Having worked with institutional investors basically all my life, I can tell you that, yes, they are smart in the classic sense of the word. However, they have jobs to do, and sometimes those jobs don't necessarily fit with maximizing returns. So they might have a more risk-averse approach than their investors want that. They certainly have access to a lot more information than the average retail investor. That is absolutely true. But the most important thing about smart money versus dumb money is it's not about the information that you have that you use to make investment decisions. It's the process by which you make decisions. So, for example, you mentioned Steve at SAC.
Yes.
We had to go through a weekly meeting with an in-house psychologist every week for the first year, where we went through every single trade that we did and explain what our thought process was, what our stop levels were, what our take gain levels were. And he would really focus on how did you feel during that trade? Literally, how did your body feel? Were you relaxed? Were you anxious? How did you feel? Were you confident? What he was trying to get us to understand was, past a certain level of knowledge, your intuition is very powerful. And that intuition is really your secret sauce. It is what makes you a good versus bad trader. It isn't just what you know, it's how you execute on it. And it's that process that makes for great investors. Every great investor, from Peter Lynch to Julian Robertson to Steve as a trader, have a very specific process. So if you're smart if you follow your process, and you're dumb if you just roll the dice.
Mm-hmm. I want to pick up on that point. You said a lot of institutional investors are risk averse, and it feels like there's a lot of risk on sentiment in the market. You can see that market concentration, obviously everything we saw with the DeepSeek sell-off, concentrated in those very few big tech names. Is that a problem for markets down the line?
It is both the market's biggest feature and biggest bug, honestly, because you've got, call it 35% of the S&P in 7 names. You've got 45% of the S&P in tech, plus the names that are tech but not really in the tech sector. Super concentrated. Don't have that in Europe, don't have that in Japan. You do have it somewhat in China, but it's kind of landlocked tech. It's tech that only operates in China. The reason they're so concentrated, the reason they're so highly valued, is because they have extremely high returns on capital. So if the average company around the world has a 10% return on capital, big tech has between 40 and 100% return on capital. Apple's return on capital is 100%, meaning that's what they make on their capital equity every single year, which is amazing. How do you value that? Is 30 times a multiple correct? That's what it trades for now, so fine, that's what the market says. But is 25 the right number, or is 40 the right number? If Apple could start growing again, 40 is probably more the right number, but it's that tension that makes U.S. companies and U.S. equity indices so uncomparable to the rest of the world, and people get very confused about that.
Yeah, it almost seems like we have two issues of concentration. We have the concentration of the world's excess returns in the US market. And then within the US market, we have concentration, which over the last couple of years has been in these mega caps that we talk about, Magnificent Seven. But when you go back through history, 100 years of stock market returns, concentration is not unique to this period. It's been very common before, and you'll see comparisons to the dot-com boom and bust. How valid are those? Are you concerned about this at all in terms of an inevitability of a downturn?
So I was at SAC during the peak of the dot-com bubble, and then the first 18 months of its blow up.
So definitely boring times.
Oh,
Nothing
yeah.
going on.
And first and foremost, the firm made a lot of money. So you can make money both ways. Doesn't matter what the direction of the market is. More broadly, I think the issue is, what do you think technology has done to indexes over the last 10 years? Because technology is a kind of winner-take-most phenomena. And we've seen that with Apple and Microsoft and the rest of the names we all know. There are no European Microsofts or Amazons or Apples. They're all here. And this is what we hear talking to European clients all the time is, thank goodness the US market exists, because otherwise we wouldn't have exposure to these very important trends. So I think this is different from the late 90s because you have much more profitable, much more globally scaled companies. And don't forget, we've had like 20 odd turns of Moore's Law since the 1990s. So technology has gotten much more powerful. And that's what we see with the AI boom now. I mean, we've had 30 turns of Moore's Law since it was invented in the 60s. We went from basic PCs to AI.
And that's where the number of transistors roughly doubles every 18 months to 2 years. And so it's been wonderfully predicted.
Yeah, the computing power per dollar is Moore's Law. It's size and it's how much it costs to access computing power. And that's really the power that we've seen expressed in these very high concentrations in the S&P, because these are the companies that take Moore's Law and leverage it into profits.
How much of this is due to the interest rate situation, do you think, that the US has just emerged head and shoulders above the rest of the world in terms of tech innovation and being able to monetize it in the capital markets? I mean, we had ZIRP. That was a thing in the 2010s, and arguably we had a low rate interest environment in the early 2000s leading up to the global financial crisis. And now we've seen a reversal. We've seen interest rates, especially on the long end, heading higher. Do you think things have changed such that maybe Europe can be competitive again because interest rates are higher? Maybe the Fed isn't such a factor with ZIRP.
Yeah, the issue with Europe, for example, just to not to pick on them, but it's a good example. It's a big, broad market and a huge economy. The issue is not interest rates. The issue is, how do you tap intellectual talent and get it capital? That is the key issue. We are very good at that in the US. It is very hard to do in Europe. It's almost impossible in Japan, and China is somewhat mixed. So you have to have that access to capital. Europe has plenty of intellectual capital, and it has enough financial capital. But what I wrote about is, for example, DeepSeek on Monday was, the biggest embarrassment is not that the US didn't get it, it's because Europe didn't get it. Europe has just as much intellectual firepower as China does, but they didn't access it and they didn't leverage it.
Yeah, and when we've been thinking about DeepSeek, something I've been also thinking about is that AI, the trade is real, but it's also very speculative. And it makes me think about cryptocurrencies. You were the first on Wall Street to cover Bitcoin, also a speculative trade. And we've sort of seen this correlation between crypto prices, tech prices. So how do you balance the risk rewards within a speculative environment?
Yes, you're right. And to some degree, crypto, thank goodness for crypto, because it's kind of kept some of the speculative excesses out of the US equity market, unlike the 1990s, where we saw just crazy numbers of IPOs in 98, 99, 2000 do spectacularly well the first day out, because there was so much demand for disruptive innovation. And that's been funneled over to cryptos. What's interesting is that it's mostly been a Bitcoin rally over the past couple of years. The rest of the ecosystem really hasn't gained anywhere near as much. Bitcoin's share of the crypto system has continued
Not even
to grow.
Doge.
To me, like, what the existential issue we're getting at is, people trust technology. There's a new generation of investors that trust technology and understand how technology creates competitive advantage and business models. And they understand it at a deep fundamental level, which is why they're basically flocked to crypto, because they understand what it is. They understand its technology. And let's face it, Bitcoin's the only technology that's never been hacked at the core level. The blockchain's never been hacked. How much can you say? You can't say that about any other technology on the planet.
Interesting.
Every company's been hacked. Every major technology, Tesla's been hacked, Microsoft's been hacked. There are hacker competitions that target those companies in a friendly way to show their security failures. We haven't had that with the blockchain, and that's fascinating to me.
What do you think about the regulatory environment changing at the SEC? A new president, it's going to be a new SEC chair. We've already seen a flood of leverage ETFs being filed for. So there are expectations that things are going to change. How much do you think they actually change this year?
I think they're going to change a lot, particularly in the crypto space, and particularly with more speculative ETFs. I think the new administration is much friendlier to the idea that let the products come out. People can judge on their own if they're good or bad or proper for their use, and let it go from there. I think that's healthy.
Where do you see Bitcoin prices going in the long run? I know that's a big
How
crystal
many
ball
commas?
question.
That's what America wants to know. How many commas?
All I can say for sure is that as long as quantum computing doesn't come along and kind of wreck the idea of a private key.
So is that the risk to crypto?
To me, that's the biggest
It's a risk to humanity if that
Right.
happens. All encryption just goes out the window if you got the keys to the kingdom right there.
Yes, I have an annual chat with a guy who used to run FBI cybersecurity, counter cybersecurity efforts, and our running joke is, we'll know that the first quantum computer's out in the wild when Bitcoin goes to zero in a day, because that is going to be the first most profitable use of that technology.
Because all cryptography immediately can be basically broken with minimal effort or a lot less effort.
That's the idea. Quantum still feels like it's a good decade away. But that's to me like one risk. Other than that, I think it can generate choppy but steady positive returns for the next decade. It's clearly a scarce asset that people understand and want to be involved with it. I think the biggest mistake Americans make in thinking about Bitcoin is, oh, we have the dollar. And that's true. The dollar is very stable. The dollar compounds at 1% a year versus other currencies pretty reliably. So we have a nice, strong currency. But for the rest of the world, they don't have access to that. And Bitcoin, like gold, is access in a way to a dollar-based proxy. In the Bitcoin's case, if more demand comes along, the price goes up.
And the dollar also, it's been moving pretty aggressively depending on whatever Trump says with tariffs. Can you explain why a strong dollar is not always great?
Well, the history of commentary on the dollar goes back to Bob Rubin during the Clinton administration. His mantra was a strong dollar is in the best interest of the United States. And I fundamentally believe that. A strong dollar is a sign that we are receiving capital at an incremental pace because capital goes where it's most well used, most welcomed, and safest. And the U.S. fits all those three things. We use capital extremely well relative to other countries. So I would prefer to see a strong dollar over time, but a sudden rise in the dollar is always a warning sign. And that's what we saw at the tail end of last year. Big rally in the dollar versus everything. And now I think it'd be healthy if some of that came off the boil and we had a little weaker dollar for the first 6 months just to reset things. But fundamentally, I'm very positive on the dollar over the long term relative to other fiat currencies.
Hold that thought. We got to take a short break, but coming up, we're talking zombies taking over the small cap space and channel. We're going to channel the ghost of Indiana Jones on today's Who Wore It Better Runway Showdown. We are back. This episode is brought to you by the number 42%, and that's the share of companies in the small cap Russell 2000 index that have negative earnings over the last year. 42% of these 2,000 companies are unprofitable, and this stat comes from Torsten Slok, chief economist over at Apollo Global, which is our parent company, but 42% aren't making any money. Does that concern you?
Small caps have always been profit challenged. The number has been as low as 25%. It's just over 40 right now, as you cited, but that's kind of, again, a feature of those names because what they're doing is trying to invest and grow into profitability. And that's what the appeal is for investors, is small caps should do pretty well over time because they're growing into profitability versus being massively profitable like the companies we were talking about earlier.
We've been waiting for the small cap rally. It seems like every analyst has said, it's coming. And then it felt like, with Trump, we're going to see a stronger dollar that's going to benefit small cap companies more levered to the domestic economy. But it just has not happened. What's preventing this? Obviously, the yield surging is not a great thing for small caps either.
Yes, for exactly the reason we were talking about. If you are not making money, you need access to capital. And that's debt capital for the most part, because equity capital is pretty expensive for a small cap. So you're going to go out and issue debt capital, and two things matter. What's the yield on the treasury, and how are corporate bond spreads, particularly high yield spreads, the amount that a company has to pay over treasuries. Those have been declining. Those are at ridiculously low levels. Spreads are very, very tight versus treasuries, but treasuries themselves have seen a push up towards 5% as recently as just earlier this month. That will make every small cap investor a little bit uneasy, because if all of a sudden the cost of capital for a small cap company goes to, call it 11, 12, 13% from 8, 9, 10, all of a sudden they're paying more for capital, and some of those companies aren't going to make it. That's what makes them zombies. It's only a zombie if they can't get incremental funding to keep on the path towards growth. And that's a big mistake. People say any unprofitable company is a zombie. Not true. There's plenty of high quality unprofitable companies because they have a clear track to profitability. But if you need capital, that's a problem if rates go up. So you're right, it's absolutely 100% rates.
And yields approaching 5%. It seems like you said, we're in the clear right now. We're hovering above 4.5%. Why is 5%? Is it a psychological level because traders aren't really used to that? And if that's the case, perhaps we're just in this higher yield environment and investors just need to get on board. Is it really so bad? And if it is, why?
Yeah, 5% is an important level, and it isn't just over the last year or two. This goes back to pre-financial crisis. 5% was a level back then, and treasuries would very rarely go over 5%. It's fascinating because debt to GDP for this country was about 60% in 2004, 5, 6.
That seems really low.
Yeah, it is, because it's now 120%. It's double, and yet 10-year yields are exactly the same, which I think kind of challenges the idea that deficits inform yields. They clearly don't, because if they did, we'd have higher yields now than the mid-2000s. So the reason 5% is a barrier is because it's been a ceiling for a long time, and because it's kind of like those old-time maps where like they didn't know what the world looked like past a certain point, so they'd say, "Here be monsters." That's what happens with 5% 10 years.
like
you get over 5 and here be monsters.
Right.
All of a sudden, we don't know what's going to happen. Should they go to 6? Should they go to 7? Who knows?
I gotta ask you, do you think value is coming back in any way? We were talking about the interest rate situation. It really hasn't been a factor this century for long stretches of time, and I think a lot of it has to do with the interest rates situation, rates being low, but now with rates being higher and the market seeming to accept them, do you think there's a place for value in investors' portfolios?
It's very hard because the minute you sort of cycle into value, you're ignoring the most fundamental trend of the last 10 years and probably the next 20 years, which is technology. Yeah. There's not a lot of tech in the S&P 500 value, for example. Apple's in there, interestingly, as the biggest holding, but it's mostly financials, healthcare, things like that. So do you want to be very underexposed to technology? Look, if the answer is yes, because you're just very risk averse, value will do fine. There's still U.S. equities. Every U.S. equity sector except energy has outperformed rest of world stocks over the last 10 years. So, to your point about American exceptionalism, It isn't just tech, it's the entire ecosystem here. We're drawing capital and using it better than the rest of the world. And I don't see any reason for that to change anytime soon. So value's fine, it's just you have to accept the fact you're not going to get a lot of tech.
Speaking of diversification, you are very anti-international diversification. Explain to me why you think that's a waste of time.
Look, I think the underlying thesis behind any kind of diversification is you reduce risk and have the same level of returns. That's the principle of diversification. That's Markowitz's efficient frontier. That's what it's supposed to do. However, it assumes that every region has the same basic risk return profile and the same ability to translate intellectual capital into profits. And I think we've seen over the last 10 years that is not the case. Europe does not have the same ability to create disruptive tech companies as the US. China has some real talent, but it's kind of hamstrung by the local government's constraint on who can get rich and by how much.
But did the DeepSeek sell-off show us that it's important to not be so tilted towards tech, like that we do need to diversify our portfolios?
Well, I think it showed that for NVIDIA. I'm not sure that it showed it for the rest of the ecosystem because several of the names were up on Monday. Apple, Meta were up on the day. And so if there's cheap AI, and it looks like DeepSeek has shown us that that's possible, that's actually such a huge net positive for companies that are going to use a lot of AI, because that means that the $50 billion that they were going to put into it this year, just pick a number,
software companies,
just has to be maybe 10 billion. Where does the 40 go? Stock buybacks, dividends, things that enrich shareholders. So I'm not too worried about that feature. I think it shows that innovation can come from anywhere, but in terms of how you think about allocating money in a portfolio, you want to be in a space where profits are allowed and welcomed, and the government says it's okay to have private enterprise that makes people very, very rich. That exists in the US. It doesn't really exist in the rest of the world.
We got to pivot here and get to who wore it better. And welcome to today's high-stakes fashion face-off, where two very different investors are strutting down the runway, each with a radically different approach to uncovering market riches. On one side, we have the treasure hunter, bold, risk-seeking, and ready to chase the hottest trends before anyone else, armed with a pickaxe and high-conviction bet. This investor is all about speed and speculation. Think AI moonshots, crypto rallies, and that one stock that got everybody suddenly talking about the other. On the other hand, there's the archaeologist, patient, methodical, and always digging deeper. They sift through layers of fundamentals, searching for value where others see rubble. Small cap turnarounds, beaten down cyclicals, forgotten corners of the market. This investor plays the long game, and we were just kind of talking about this, Nick. But who is walking away with the prize this year? Is 2025 about slow, careful excavation or about grabbing the treasure before someone else does?
Ooh, that is.
Or is that a false paradigm?
It's a wonderful paradigm. It sort of encapsulates a lot of the investors I've met in my career. That's very neatly summarized as like the fast action trader, a Steve or a lot of other investors, versus the deep value people that just go about their job methodically. And I would say for the year, it's still going to be the first camp. It's going to be the people that are embracing change, embracing innovation, and playing that macro trend. I think the value investor, the really nuts and bolts investor, is always going to do well. They're always going to do 10 to 15% a year because they're finding valuable companies that are mispriced. But if you're talking about where's the trade this year, I think it's still in the first category.
We actually have a couple minutes left. I wanted to dig back to, no pun intended, get back to your archaeological days here. That's something that you were studying in school. How did this prepare you at all for trading, treasure hunting in the old sense? And that I know that's not really what archaeology is about. But
no, archaeology is an academic discipline, and academic disciplines really focus on writing. And to this day, I write 2,000, 3,000 words every single day, and my partner does 1,000 words a day. So to me, it taught me how to write. It taught me how to process information with an empathy for the reader, to understand not just I want to express something, but I want them to hear it in a way that they can appreciate it. And that to me is what liberal arts colleges do best, which is I went to Haverford College, where Howard Lutnick actually went. He was a senior and I was a freshman.
Go Birds. See if they win the Super Bowl.
So that's what it teaches. It teaches you to express yourself in a way that people can hear you.
And I guess also archaeology, kind of looking back at history, at trends. I feel like that's also what a lot of traders do every day.
And that's a huge part of our work at DataTrek is we'll go back and look at, okay, let's look at 10-year yields. People are freaking out about 5%. Why is that? You wouldn't know it from looking at the last couple of years. You got to go back 20 years. And then you say,
Does history usually repeat in the markets?
I think now that so much of our trading day-to-day is algorithmically driven, I think you have to have a real appreciation for near-term history and long-term history, because that's what the algos do. They look back 100 days and they look back 10 years and develop a model of how the world's supposed to work. So if you want to understand what's going on over our shoulder, you do have to understand history very closely.
We got to wind things down here at Stocks in Translation, but make sure to check out all our other episodes on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms, so be sure to leave a comment, and subscribe wherever you get your podcasts. This is going to end it for us. We'll see you next time on Stocks in Translation.